Hi, everybody. Thank you for joining the webinar. We are having some technical difficulties, so I apologize for that. For those that are on, just bear with us for a few more minutes, and we will be up shortly. Thank you for your patience. Hey, everybody. All right. I think we have everything up now. So again, thank you for your patience. Thank you for spending the time with us today to learn a little bit more about risk models. Typically, larger companies traditionally have had risk models for quite a long time, and they haven't really changed. And while younger tech companies in the last 10 years are a little bit more agile and they're more likely to evolve risk models. Obviously, there are exceptions to the rule, but today's day and age, with the big data in place and the ability to track so many things in the digital age, digital data is a new criteria. And this is certainly a criteria that we want to integrate into today's risk models to make it more efficient and more effective. That's what this webinar is about today, and hopefully you guys will be able to learn and take away some of the things and learn from some of the standards and best practices that we put in place. Before we jump in, some quick introductions. My name is Albert Lee, Senior Director, and I manage data and analytics, specifically marketing analytics for Beyondsoft Consulting. Also on this call is Jayakrishna Venkatesh. We happily call him JK for short. He manages the practice from the Texas region. He's also serves as our lead data scientist, and he'll be walking you through a lot of content later today. A third and final introduction I want to make is obviously JK and our own parent organization, Beyondsoft Consulting. Beyondsoft Consulting is actually a global IT consulting firm headquartered in Beijing, China. We've been in place there since around the 90s, and since 2004, we've expanded into North America. We have a number of clients there. We're continuing to expand, but some of our major engagements include Microsoft, HP, and Toyota. We are also traded on China's stock exchange for quite a while, and we have a tremendous growth, and we're looking forward to hopefully expand further into North America, into the East Coast, and hopefully be able to build partnerships with each and every one of you. That said, as we move into the presentation, you'll see on the interface that you do have the ability to ask questions. Everybody has been muted, for this call, but if you do have questions, feel free to punch in the question. Since I'm serving as your moderator, I will review the questions, and we will have two separate breaks, one in the middle and one in the end for quick Q&A. And I will narrate your questions for JK. That said, there are other services that Beyondsoft provides outside of just data and analytics that you can see on this quick slide here. Consulting and strategy, QA and testing. We also do cloud services, digital enablement, and globalization. JK and I are part of the data and analytics group, and hopefully you enjoy our content today. Passing the baton over to JK, and we can get started.
Thank you. Again, group, welcome to the webinar today. We are going to be looking specifically at a few agenda items, talking about how risk models are being used, what a refresher to risk models for people who have not been exposed to risk models in their professional experience. This is going to give you a refresher to what risk modeling is. We're going to talk about what sort of capabilities digital data gets in, and how do we essentially use these digital data points in risk modeling. And then finally, to make sure we show you how these get used in real-life examples, we are also going to look at a couple of case studies to show how digital data indeed helped a couple companies in real-life risk situations. Starting off, The goal of any risk model is to basically assess the risk vulnerability of any transaction or a customer profile creation. It could even be used in cases where you're trying to buy something. It could be that you're on Amazon.com, you're trying to buy a product. There might be multiple risk models running in the back end trying to assess the validity of the model, and it's also going to be used in terms of understanding if the customer himself is who he's claiming to be. It's also to ensure that we reduce risk exposure and increase the approval confidence of every transaction and every profile creation. Ultimate goal would be to make it the best experience for good customers, block threats. What I mean by this is, for a good customer, the easiest experience should be getting an approval. And for any other customers who are either not clear on what they're putting in, or if it's a fraudster trying to scam the situation, again, the best experience to make sure we deny them. Anything in between is going to be held or manually approved. The goal is to make sure that the manual approvals are reduced as much as possible, and instant approvals and instant declines are coming in as soon as possible, and that depends on the robustness of the risk model. We have multiple use cases for risk models, and this is all happening in your day-to-day life without you seeing it, because it all happens behind the scenes. A risk model might typically be used in funding issuance. What is funding issuance? When you ask for a loan, when you ask for a credit line, when you ask for an auto loan, mortgage, they make sure that on the back end they run multiple risk models, which looks at your credit worthiness, which looks at your payment history, to make sure that they are indeed giving it to the right person and they're indeed giving it to people who can pay it back. It can be used in money transfer. Mostly in cases where people use some sort of funding instruments, bank account, a credit card, sending money to someone overseas. Again, they try to make sure that someone has not stolen credit cards and trying to send money. Risk models are run in the back end. Profile approvals. When you create customer profiles, that is also when it's used. Transaction approvals. When you send a transaction, they try to make sure that the customer is who he's claiming to be and the transaction is done from legitimate credit sources. A typical example of this could be creating your Amazon Prime account. That is an example where multiple of these come in, especially profile approval and transaction approval. They try to see if the customer is who he claims to be, and they also try to see if your credit card that you put in is indeed your credit card. So that could be a perfect example of how multiple of these use cases get used in just one specific step. With that, we're going to move into specific digital data capabilities on how what all digital data can bring to the table in terms of risk modeling. Digital data itself is a very large topic, because we can have a separate topic, we can have a separate whole webinar just talking about digital data capabilities, its legalities, what can be captured, what cannot be captured. So it's always good for the product managers and the data scientists to work with the legal team to ensure what can be tracked and what cannot be tracked before a particular risk model is being used, specifically with digital data. With that said, there is an endless list of digital data points that can be captured or measured. This can be done through systems like Google Analytics, Adobe Analytics, or even logs. What sort of devices are you using? That is something that digital data captures. Are you coming from a desktop, computer? Are you coming from a mobile phone? Are you coming from a media device? It can also try to understand how are you using this device? What sort of operating systems are you using it from? What sort of browsers are you coming from? It can also tell you the typical time you spent on the website. This is important in cases where transactions are done in record times, where bots are being used to run transactions. This is also going to be important where person is trying to typically send a transaction, and if the transaction time historically used to take 4 minutes for him and it suddenly drops to 10 seconds or it goes to 20 minutes, that could raise flags. And it can also say where these people are coming from, where these customers are coming from. This is important because in the world, in the US, there are very specific pockets where fraud rates are very high. We can talk about Miami in the US, we can talk about some parts of India, we can talk about some parts of Africa, where a lot of fraud and scams originate from. So it's important to know where the customer is logging in from. And then finally, because the digital data also captures specific behaviors of the customers online, we can talk about whether there's a new customer, if this customer has completed one transaction in the past, what sort of behaviors has he put in, what are his preferences. That could also go into what gets used in terms of digital data for risk modeling. With that, now that we've seen the capabilities of digital data, and we've also seen how what risk models are being used for, this section is going to go deep into how digital data is specifically used in risk modeling. And I said again, I repeat it, it is imperative for every data scientist to make sure that the data that they use is cleared of PII, it's cleared of legalities, so that every data point you use is legal and it's allowed to be used in your risk models. That is something product managers, data scientists work with the legal teams and the product teams on. There are 5 steps. And again, based on the scenario, this could be 3 steps in some cases. It could be 5 steps in most cases. These are the 5 fundamental steps that are used in pretty much every risk modeling exercise, with or without digital data. Exploration. Every risk model starts with an exploration step to understand what is the situation, what data points do we have in our possession, and then it goes to assessment of the current situation, and then it goes into selecting of final variables. This is where a data scientist typically hops in and works with the product managers to understand what all variables are used and what all variables are being considered for the risk model itself. And finalization of models. We're going to talk about this in a bit, and then finally it gets into validation and scoring of the model, so that the model itself is just ready for real life use. It's not something that has edge cases that it can miss. This is where the model gets put to real life test before it gets put into production. Step number 1 is exploration. For any exploration step, for this specific scenario of having digital data and risk modeling, first scenario is applicable to situations where a current risk model does not exist. There's no risk model and a new model is being built up. In this specific case, it's basically building the model from scratch. Understanding what is being tracked, what is not being tracked from a digital perspective is going to be very important. This is going to be important because if you need digital data variables that are not currently tracked, you may need to work with the product managers who are working on that specific product to ensure that that data is being tracked in the short or the midterm. That way, it gets put into the product backlog, and the product manager ensures and enables that this data is being tracked. Example, if geographic location is not being tracked and you absolutely need it for the model, because let's say you're building a model for a money transfer company, it is imperative that you work with the product managers, the data scientists work with the product managers to ensure that that geographic tracking ability is being put in Adobe or Google or WebTrends or whatever the tool of choice is, to ensure that that data point can be used in the model itself. Once the requirements are set in and the models and the data points for the models are being logged, for the ones that are not currently tracked right now, you will be working with the product managers to ensure that you have defined requirements for the collection of that data points. Do you need city level data? Do you need geographic country level data? Or do you need very specific IP level data? And does the legality allow you to get that? All of these are things that are discussed in this step. And then finally, you bucket your variables into different categories. First bucket could be geography, second bucket could be customer type, third bucket could be funding type. So based on the use case, based on the type of your business, you want to bucket them to different categories so that you don't end up in an overlapping situation. And for all the data scientists in the team, you know that you don't want to have any sort of multicollinearity or correlations between data models, between data variables. So this is going to help you make sure that you don't pick up more than one variable from one bucket explaining the same specific data point in example location. And the second scenario is going to be applicable only to situations where a risk model is in place. The first step is to understand the scope of the risk model in place. The second step is to make sure, like the first scenario, is to log all the variables considered for the risk model, and then taking note of any digital data variables that need to be mapped, and then also making sure that these digital data variables do not overlap or correlate with the current data variables that are in the current model. This is again to ensure no correlations or multicollinearities are found in the modeling. Once the exploration step of data variables is done, we get into the actual assessment. The assessment is pretty much done with all the data, historical data you have in your possession, to ensure you understand what your pockets of concerns are. You can have multiple things that you can assess on the step. I'm not going to go over every step here, but I'm going to go over key examples of what all could be considered in the assessment step. When you get your chargebacks from your Visa processor or your American Express processor, and for people in the call who are new to chargebacks, typically when you put a transaction in, it goes through Visa, MasterCard, or Amex. And then they come back and say that, hey, this transaction is flagged as a fraudulent transaction by my customer. Why don't you go back and do your assessment and come back to say if this is really a fraudulent transaction, or you have data saying this is indeed your customer that did the transaction. So that data is going to come back, and that is going to be used for the assessment step. So going back, we can look at what type of funding instruments are causing the highest amount of frauds. And typically in the industry, gift cards are known to be the highest in terms of fraud rates. That's mainly because a gift card could be lost, a gift card could be transferred, a gift card could be bought on one person's name and used on another person's name. It's very easy for people to use gift cards in fraudulent transactions. Second example, if you focus on the third diagram on the top, that's geographies. Again, if a person typically transacts from, let's say, if my zip code is somewhere in Frisco, Texas, 75035, and if someone is using my credit card from, let's say, somewhere in California, 95036, the system immediately understands that there is something going on with this person's credit card usage. Now, it could be that I'm traveling and I'm using it in California, but still the system pings a risk saying, hey, this is a risky transaction. Make sure you call the customer before you approve the transaction. And then finally, you also have things like seasonality. Retail suffers very high fraud rates in the November to January seasons because of high retail purchase transaction limits. So it is important to consider all of these scenarios in your assessment stage. And based on where your highest pocket of fraud rates are, you want to make sure that those transactions are flagged and variables are considered to ensure those transactions are covered. There are other cases as well. As you see here, it can depend on the customer type, it can depend on transaction types, but I called out a few as an example. And finally, on the third step, you get into variable selection. You've done the whole logging of variables, you've done the assessment to understand what all you need to capture, and then the variable selection actually gets into a modeling stage. Again, in like the exploration stage, you have two scenarios here. First scenario is if a new model is built with digital indicators from scratch. A full list of variables need to be established even before the modeling exercise starts. Digital data, of course, will not be replacing any customer data, so it is important to make sure that in addition to the digital data points, you also have offline customer data elements and transaction data elements that will complement the risk model in addition to the digital data elements being used. And it is very important to know here about what are called trump variables or trump rules. In any risk model, a trump rule is a rule that pretty much trumps every other decision that are being made. So, for example, if I'm a US company and if I only want to allow US transactions, if geography comes in and if I see a transaction from India, that will be a trump rule. That means if I see India is not equal to US, that's going to decline the transaction right there, even if the other decisions are being met and approved. Best risk models are the ones that are worked on stress situations. This is something that is going to be very important for every modeling exercise. You want to make sure that your risk model is stress tested on multiple scenarios to cover for all types of edge cases. And the second scenario is a scenario where an existing model is present and it's being enhanced with new digital data. In this data, again, it's important to ensure that you have a compatibility check of all variables. This is to make sure that if you're already covering geolocation or geography from your transactional data elements, you don't want to capture that with your digital data elements as well, mainly because it's going to correlate and it's going to skew your model statistically. If it's a real-time model, if your current model is a real-time model, and if you're trying to enhance that with digital data, it is very important to make sure that you used pre-processed or partially processed data from Adobe or Google. Depending on what products you use inside Adobe, you want to make sure that you have live data available or near real-time data available. If there's a lag in data points, you want to make sure that that does not affect the current model, because it's typically Adobe processes transaction. It takes about 45 minutes. If a person is waiting for a real-time transaction decision on the website when he's processing a transaction, you don't want him to wait for 45 minutes. Instead, you want it immediately approved. So you might want to consider resorting to partially processed or pre-processed data if you're using Google 360 or Adobe Livestream. A definition of a visit session needs to be clearly understood to know impacts in decision making. What is considered a visit in Adobe might not be the same as what is considered a transaction or a visit by your transactional systems. Making sure they both have the same definitions and aligning their definitions is going to be very, very key in making sure that the two models or the two data points, offline and online, act the same way they should be acting to ensure that they work in unison to promote and make the risk model robust. Once the variable selection is made, this is when you get into the actual finalization step where you build models. All the data scientists in the call know that you want to make sure that you have more than one model in place. So the finalization step will have the final 10 models or 5 models selected, from which one model could be used and put for production. And this is done mainly because if a model fails acid test or stress test, you can quickly resort to your plan B and plan C instead of starting the modeling exercise from scratch. And finally, you do validation and scoring exercise. And this exercise is basically thinking of your modeling as your production car. And if your production car is being put on a crash test in real life scenarios or stress test scenarios, trying to see if that will survive the crash test or how well will it survive the crash test. This is going to be very important to ensure that your model is able to withstand the harsh realities of the real world outside. It could be seasonality, it could be the volume of transaction, it could be the type of customer. All different stress tests needs to be ensured and adopted to ensure that this model is able to withstand any amount of stresses that it could be exposed to in production. Finally, in cases where you have a model that is already present and you're trying to create a challenger model and trying to A/B test the challenger model against the original model, and a scoring is required. A scoring is required mainly because when you're adding new variables in and when you're creating a new model, you want to make sure that all these additional variable data points are able to give some sort of a lift to the model. And if that's not the case, adding the new data elements might be redundant and it might even give you a false fit. So it's very important to make sure that the new variables that are getting added are indeed giving a true lift in the decision making, either in terms of the accuracy or in terms of the confidence of approvals. With that, we're going to go over to some real life use cases, but we're going to take a pause here.
Hey, JK, thank you for taking us through your best practices and standards. I want to take a quick 5-minute break just to get some Q&A in. We do have a few questions that have come up. I don't think we'll be able to get through all of them, but at least we'll address hopefully 1 or 2 in the next 5 minutes. So for the first one, and I'll read it verbatim here. Do risk decision managers like CyberSource capture digital data elements? If so, do we still need another separate risk model?
Wow, great question. Perfect. So CyberSource, for people on the call who don't know about CyberSource, CyberSource is a decisioning engine that is already provided by Visa. You have an option to buy the tool and use it as a risk manager. Most of the companies that don't have in-house data scientists use this risk model so that they can immediately deploy it along with their processing rules. When a transaction is processed, they hit CyberSource, the tool that Albert just mentioned, and they get a decision back and they pass it through. For more sophisticated companies, like the one we're going to see in one of the use cases, they use a combination of CyberSource plus an in-house model. What they do is they run CyberSource, give the decisions first, they get the decisions from the CyberSource, feed it into the risk model itself, and then add additional data elements from the customer side, from the transaction side, enhance the model, and then put out a final decision. So you have 2 options. If you don't have data scientists in-house, you can just go with the risk model, with the CyberSource decision manager itself. If you have data scientists in place, and you have the liberty to use that along with the custom model, you can get that into your own model and then apply all other digital variables or offline variables you have and enhance the accuracy of the decision making, and then use that as the final decision to either approve, decline, or pen customers' transactions before you send them through.
Perfect. Let's go with another question right here real quick. I work for risk analytics in a healthcare company. Can you explain how and where I may be able to apply risk models in that field?
Great question. Most of the times, people always talk about risk modeling in either retail or the financial sector. But what we need to know is that healthcare is probably one of the largest areas outside of financial services where fraudulent transactions are very, very, very prominent. This is mainly because I can steal someone's social security, I can steal someone's healthcare ID, if it's from a lost card or something, and I can start processing transactions. So for a healthcare company, the short answer is yes, you could use risk modeling for transactions, but then where you use it is going to depend on the scenario. One example I can immediately give is to make sure that when a person sends a payment amount for a healthcare service, a risk model can be used in the backend. When a person creates a patient portal account, I'm a patient, I'm trying to get services from a specific hospital, they use something called a patient portal. And at that time, when you put in all the information, a typical process is to go through a manual verification of all these steps, which takes a lot of time. That could be sped up if you have a risk model in place that pretty much checks every data point that a customer puts in to ensure that the customer is indeed who he claims to be, and the healthcare credentials that he gives in, be it your insurance information or your payment information, all of that are indeed his own legitimate information and not stolen information. It is going to be much more complex for a healthcare domain, but absolutely, risk models do exist and are very prominent in the healthcare side as well.
All right. Definitely keep the questions rolling in, guys. A lot of good ones here. We'll take one more before we resume with case studies. For this one, I work for the financial arm of a car manufacturer. Can you explain or give examples of how risk models can be applied here?
Great. So I'm thinking of a car company that might probably have a financial arm that's working with it, which is basically giving loans for their customers to buy cars from their brands. And risk model is going to be very, very important for all of these companies. And in most cases, all of these companies will have their own risk models. So the only question to ask is going to be, how do digital data elements fit into these existing risk models? One example could be if I'm trying to buy a car and if I'm applying for a credit, I'm giving all my information in. A typical process is to run my FICO score, get my credit scores, see my credit worthiness, and see if I'm good or bad for the loan. Additional data elements that could be added in, typical data elements that could be added in are, what is the type of information is this person giving me? Is this indeed his own information or is it stolen information? Also, it is important to make sure that if the person has a history with the company, especially for captive units of car manufacturing companies that run their own financial services, you may have a history. If I'm a returning customer, you may have a history about me. I bought an XYZ car model 4 years ago. I paid every payment on time and I closed the loan when it was time. So for me, you can ease the model a little bit because you already have enough information about me to tell you that I'm a very genuine customer. But then if you have bad history about me in the past and you got details about that, that could be a way to ding my score and probably decline my application. In addition to that, it might also be important to check all the digital characteristics of this person. If this person claims to be in Chicago, but the IP clearly shows that he is dialing in or coming into the website from some remote part of India or any other country, that might give you a clue that this person is trying to either defraud the system or trying to get a credit line that is probably going to be used by someone else in the country. So it is important to make sure that these digital data elements are fed into the current model, if they already have a model, and being used for decision making real time.
Perfect. I have a few more questions, and at this point, we'll save it for the end of the presentation. For the rest of the audience members, if you do have anything, don't hesitate to type in your questions to me, and I'll make sure they're in the queue. For now, let's get back to the presentation. Our section 4, our last section here, will detail out 2 specific case studies that we have worked with some of our past customers in terms of implementing risk models with digital data indicators. JK, back to you.
Thanks, Albert. So in this first scenario, this is a financial services company, and this is for a very popular brand name in the money remittance space. A few famous names in the money remittance space had constant trouble from digitally savvy fraudsters. And these fraudsters typically work across the world. These are not pockets just in the US. These could be pockets in China. These could be pockets in India, Africa. You can even have pockets from as far as Australia, where they're operating so that they can mask their IPs and they can try to put in fraudulent transactions and try to get money out of the system. And these are also networked rings. They don't work as an individual customer. One person could be operating from the US, one person could be operating from India, so they operate as a ring so that they can bucket their system off of multiple systems, multiple IPs, and multiple transaction histories. They would use stolen credit cards, maybe even takeover accounts, and run hundreds of thousands of transactions every single month. And these transactions would not be big transactions. They would send off ping for $50 first, then for $100, and then they would send thousands of these transactions amounting to hundreds of thousands of dollars. The problem that the company faces, let's say in this case, the money remittance company faces, is that when a stolen credit card is used for a transaction, the transaction goes through because every line item in the transaction record looks like it's a legitimate transaction. So the company looks at the transaction and says, okay, everything looks good, we're going to send the transaction through. And then immediately after the transaction went through, 2 months later, Visa comes back and says, hey, my customer told me that this transaction through the Visa card was actually not authorized by him. Can you go check it out? And the company has 2 options. The company can either take in the loss, pay Visa back so that Visa can pay back to the customer, or number 2, fight back with any sort of data elements. And if you cannot do either of this, it's always easier to fight back the transaction at the root of the transaction where the transaction is put in, where you can collect digital data elements to go and fight the transaction and decline it if it shows suspicious behavior. The exploration of these cases was near impossible in this specific use case because they were not capturing any digital data. Most stolen credit cards would come with all the information about the credit card, and if it was a friends and family transaction where a stolen credit card was used for a transaction by a friend or a family, the person might even know the address details of the actual transactor. So everything in the transaction is going to look like it's a legitimate transaction. So it's almost impossible to find that this transaction is suspicious. So the only data points we resorted to in this specific case was digital data. So as the title suggests, this was about identifying and safeguarding customers from fraud scam rings, specifically using digital data imposed on top of the transactional data. How did we do it? We did an exploration. So like I said, when Visa sends back, Visa or MasterCard or American Express sends back the list of transactions that are fraudulent, it has a lot of data points in it. It says, this is what they did, this is what the customers complained, he didn't do the transaction, or he lost the credit card in some time, and around the same time this transaction happened. So this helps us understand what are the transactions that were fraudulent, what were the names of the customers that got defrauded, and we also try to go back and understand what IPs did they send the transactions from, what countries did they transaction from, what time was it sent out, if we have the digital data captured. And in this specific case, there was an implementation of Google Analytics for the customer. So they were able to go back and explore every transaction and connect the digital data points connected to every transaction. Once the exploration was done, an assessment was made. This is a step where there was a reverse check done, where fraud rates were connected to specific digital behaviors. And in this specific case, fraud rates were coming from shared IPs. And shared IPs is basically you have 3-4 customers with unrelated who have no relation with each other. Let's say I'm here in Texas, Albert's there in California, and then you got another person in New York. You got another person in Idaho. All the 4 customers have nothing in common. No last names, no location, nothing in common. But then when they send this fraudulent transactions, you have a shared IP. And in reality, this is not possible at all unless one person is running all these transactions from a single computer, from a single IP. And this was one of the things we found out that was common for all these fraudulent transactions. And then the second thing that was important here is the transactions times for most of these fraudulent transactions were very, very high, very, very fast compared to an average transaction. And in this specific case, an average transaction took anywhere from 4 to 8 minutes, but an average fraudulent transaction, a bulk of them, took less than 20 seconds. So that was another indicator that told us that something is fishy about these transactions. Finally, for the solution, what we did is we incorporated these specific data elements, which captures IP, which captures what we call as device fingerprints. So just like how a human has a fingerprint, device also has a fingerprint, which could be a combination of MAC address, IP, IMEI, combination of all of that put together can uniquely define what your device is. We got all of this in, tracked it, sent it into the risk model, and we also made sure that we tracked transaction times for every transaction. These were used in the model itself. This is a small example of an output that we got from the model. For privacy and security reasons, we cannot show the final model that was put in there, but this is one of the steps in the model itself. As you see here, multiple variables are being used, both offline and online variables are being used to make sure that you bump up your R-squared, which is the predictability of the model. Finally, the solution was to put in transaction tracking with IP and made sure that any transaction that had common IPs without any other common links like last names, addresses, or relationships, etc., were either denied and in some cases put on hold for manual verification. I know that this customer is very genuine, but maybe something has happened, or maybe he has given it to his daughter who has changed her last name, and she's running the transaction. In those specific cases where our confidence level is a little lower, we pen the transaction, hold it for manual verification, where a customer service agent could call the customer and verify it. And we also made sure that session length or transaction length under 5 minutes were put on hold, and those under 45 seconds were immediately denied, because in no scenario would you be able to complete a money transfer with this specific platform under 45 seconds with all the information they ask, unless you're running a script for a bot. So that is the first case study, which talks about a specific use case for a financial services firm. And the second one is a case study that was worked on for a non-financial services company. And this was interesting because here there's no case of credit card being stolen or account identity being stolen. This was done for a SPA consolidator. What is a SPA consolidator? Think of Expedia consolidating travel products like airfare, hotels, rental cars. Just like Expedia, this was a company that was doing international spas, that was doing the same for international spas. They would consolidate multiple spas and they would give rating, and they would also let customers book spas and appointments from their website. Their challenge was different. Their challenge was that their review accuracy. So when you go into a spa, you can review the spa on how was the service, what did you like about the spa, what did you not like about the spa, and this was done for pretty much all of their spas. The biggest problem they faced, and some even ended up in lawsuits, was that some merchants put in their own reviews. So if I'm running a spa, I go in and put my own review saying my spa is 5 stars, and I put that 20 times to dilute the rating. So a person who looks at the spa might think it's a 5-star spa, but in reality it might be like a 2-star spa. That was one side of the problem. The second side of the problem was that some of the customers who were not happy with the services, let's say they thought the spa was too expensive, or they thought the services were not up to mark, instead of putting in just one review, they would put in 100 one-star reviews, thereby reducing the overall rating of the company. because this is a review site, there is no other data that proves that the customer is, the customer is trying to defraud the review system or the platform. So the only data point we could resort to were digital data points. So the exploration quickly yielded that some of the clustered bad reviews had either the same language per our natural language processing platform, or were coming from the same device fingerprint, or had a shared IP. What that means is, if a person, even though he's creating multiple user accounts, he's putting multiple reviews in, they might be connected to a single device, or they might be connected to a single IP. So we were able to get those to connect to a single IP, and the ones that got connected to a single IP, we made sure that we either denied them or manually reviewed them. And in addition, we also put a rule in there, a trump rule in there, like I said before, that said, if a person tries to put more than one review in a 6-month period for the same spa, we would deny the review and put the customer on what is called a suspicious list. So that if the same activity happens from the same customer, we would block them at some point. So takeaway of the solution, we did an exploration on a representative sample of merchants, mostly the ones with troubled ratings and lawsuits. We looked at the troubled reviews, specifically from those customers that either raised complaints or spas that raised complaints. And we uncovered that almost 90% of these duplicate reviews came from shared IPs, or they came from shared device fingerprints. And the solution was to enable IP and device ID tracking, and we also put a digital counter that will count the number of reviews from every user to either decline them or mark them as suspicious reviews. Final solution ended up enabling IP tracking in the risk model itself, ended up having device fingerprinting added into the risk model, and then it also records the IP address of the customer and the IP address of the spa. So if a spa tries to put in their own ratings, and if it comes from the same IP around the address of the spa itself, we would flag them, and we would put the merchant on a suspicious list. So this acted two ways, so it's not just biasing it to the customer or the spa. And then finally, we were able to take delete every suspicious review from the history, and for the future, we applied the risk model so that 8 out of 10 reviews were removed if they had suspicious velocity or reviews, and the others went into manual reviews so that someone can manually review it or talk to the merchant or talk to the customer before they can approve or decline the actual review. With that, we come to the end of the presentation. We can take in more questions.
Thank you, JK. Great presentation. Thank you for sharing your time in terms of your experience and best practices and standards that you've accumulated over the last 10 years. Please definitely keep questions rolling in. Feel free to type it into the interface. I do have a queue of questions here that we can kind of go over. We have about 10 more minutes left, so let's see how many we can get through. Okay, here we go. First question here. I am a data scientist supporting a financial product team. We have a risk model that doesn't use a lot of digital elements, and I'm pitching to redo the model now with digital elements. How do I explain the ROI to my manager?
Great question, because this is a question you will get asked if you're a data scientist or a risk analyst. I'm going to answer this question in two parts. If you already have a model that is currently in production and you don't have any plans to renew it in the future, that is when this becomes very important, where you try to put some sort of a dollar amount to it. The way I would help you out is that you create this model, you tell them that based on the number of fraudulent transactions you see and based on your assessment, you come up with a simulation of how many transactions you could save. Example, currently, without digital data elements, you are losing $1 million in losses. Let's say out of those $1 million, you got $400,000 that are being lost, let's say because of shared IPs, or let's say because it's coming from credit cards that have very close to expiration date. If you got these two and you know with 90 or 95% confidence that these transactions are fraudulent only because of these two reasons, you can go in and simulate, let's say, 6 months of transaction or 1 year of transaction, saying, if I had declined all of these transactions, or if I had saved 80% of these transactions, how much could I have saved? So let's say it's $1 million bottom line. Out of that, 40% had shared IPs. That's about $400,000. And about $1,000, if you save at 80% of the transactions, that's $320,000. Now, with the $320,000, also try to calculate how much time are you going to spend in putting this model in place, how much resources are you going to use, if you're going to use any APIs, shared APIs or enterprise APIs, how much is it going to cost? Get them all together. Let's say that's $100,000, including the time of your team. $320,000 minus $100,000, your ROI to the team in the next even 6 months is going to be $220,000. So that's the easiest way you can quantify it, by simulating it even before you build the model. So that way you're not just telling them that you need to build you need to make the enterprise model digital ready just because we need to flow with the industry. At that point, you're quantifying it with dollar amount, saying this is exactly how much you could save on a ballpark if you put this model in place with digital data elements.
Perfect. For this question, can you explain how risk modeling could apply to non-financial and non-retail use cases?
Oh, great question. Great question. Like you saw in one of the use cases, I knew this question was coming. So that's why I put one of my use cases. I have more than 20 use cases, so, but I made sure that I picked one from a financial and one from a non-financial sector. So the one you saw about the spa company, the International Spa Consolidator, that is a non-financial use case. If I can call out another example, if there are multiple companies just in the Dallas area that focus primarily on dating or your wedding services, you're trying to get into a network, try to find someone as your life partner or your friends, all of that. At that point, it is important to make sure that the profiles are clean and go through some sort of basic checks so that people don't get scammed. So in those cases, a risk model is going to be important. And there are multiple companies that already use digital risk models when a person creates a profile in a dating app. I go to match.com, I create a profile. There are some basic checks and balances done to ensure that you are indeed the person you're talking about, and you are not some sort of a bot trying to get information out of the site. So those basic checks are run in the backend to ensure that the customer base is clean and authentic. That's an example I can think of. The other example I can think of, just like the spa scenario, is Yelp. Yelp uses multiple, I don't know how many, but multiple risk models for both reviews posted and for the type of customers who create profiles to ensure that they don't have any fake profiles putting in reviews, fake reviews. So those are two examples I can think of where it doesn't involve any dollars, it doesn't involve any transactions, but they still run risk models in the backend.
Okay, this person works for a bank, and they have risk models in place. The risk models are 5 years old. The question is, should the risk model be updated now? And if so, how often should a risk model be updated?
This is an industry standard question. Typically, most of the banks do an in-year review for validation and scoring of the model, irrespective of whether they use digital data or not. So every year, they make sure that before the financial year closes, they do a scoring, and when the financial year starts, they try to either revalidate the model or rebuild the model from scratch. Typical rebuild takes about 5 years before they consider a model for a rebuild, but revalidation happens pretty much every year. With that said, if you're trying to include your digital data points in your revalidation, that will be a much larger step. So it is very important to work with your product managers and your financial service teams to see how best you can use these risk models without changing any of their current schedules. So the best example, the recommendation I'd give you is that when you're doing your next revalidation, you should work passively. If you're a data scientist or a risk analyst, you should work passively by the side of your product manager to see how best you can prove the value of the digital data elements. And if you can prove it in the first revalidation exercise, you can put it on a test mode in the next revalidation exercise. So I would say that at a minimum, you try simulating the first year, and after that, every year when they go for a remodeling exercise, you also keep remodeling both your variables and your model itself. That applies both for digital and non-digital elements.
Perfect. Quick time check. We'll have one last question. What does a company lose by not adding digital data elements into a risk model?
Got it. Okay. We touched upon this briefly in the use cases. A transaction might look like a very, very authentic transaction because the credit card number is right, your CVV or your CID is right, your expiration date is right, customer's name is right, address is right, transaction amount, it's not too big. Everything looks right. Assuming I don't have digital data in this case, everything looks right in the transaction, I'm going to pass it through. And then if I'm a person who's a friend of the actual card user, I know all these details, you're letting a fraudulent transaction go through, it goes to whoever the processor is, Visa or Amex or MasterCard, and then the actual customer credit card user will call Visa and say, hey, this is not a transaction I passed through. And then Visa will come back and ding the company. That is the best example I can give you on what happens if you don't use digital data in this age. 10 years ago, it might have been, you could have still run your model without digital data elements. At this point, because the fraudsters are so savvy and they can pretty much, and because the world is so open in terms of the data available, it is very, very easy to bypass risk transactions that don't have digital data captured. So it is very important at this point that if you're a retail or a financial company, that you don't have a choice to run a model without digital data elements. It is very, very key to ensure that the digital data elements are captured and considered for the risk model itself.
All right. Well, thank you very much, JK. I think we'll wrap it up here. I hope everybody enjoyed the presentation and have some takeaways to either build or refine risk models for your organization. If you have any questions, please do not hesitate to contact JK or myself. Would love to help you guys out with risk models and continue the conversation. Definitely looking forward to building any business partnerships if that's of interest to you guys. Again, our contact info is right there on the slide. Thank you once again, and have a great day.
Thank you all for your participation.